What if the biggest risks in your retirement portfolio aren't what you think they are? What if the standard advice from financial advisors, the constant refrain to play it safe, de-risk and protect what you've got, is actually a surefire way to lose your spending power over time? It's a terrifying thought, especially when you've spent a lifetime building your nest egg. As the legendary investor Warren Buffett grew older, his mindset underwent a profound transformation. He shifted from being a full-throttle wealth builder to a master of strategic wealth preservation. This change wasn't just about what he decided to buy. He became almost obsessed with what he chose to avoid. Now, to be clear, Buffett has never published a formal list titled, "Don't buy these after 60." But if you meticulously study his actions, his shareholder letters, and his advice over the decades, a clear and powerful blueprint emerges. Today, we're pulling back the curtain to reveal 5 investments Buffett consistently warns against for long-term investors, especially those entering their golden years. This isn't just another list of tips. This is a look into the mind of a master, designed not just to protect your nest egg, but to ensure it can support you for a lifetime. The foundation. Why Buffett's mindset shifted. First, we have to get one thing straight, because it's the absolute key to understanding everything else. Warren Buffett knows that turning 60, or any retirement age, isn't a finish line. In today's world, it's the start of a new marathon that could easily last another 30 years or more. And over that 3-decade span, the most significant danger you face isn't a sudden, dramatic stock market crash. It's inflation. He has called inflation a silent thief that slowly, relentlessly, and invisibly eats away at the value of your money. He realized that most people in retirement and the advisors who guide them start playing not to lose. They fixate on avoiding short-term drops in their portfolio's value. But here's the crucial insight. In a world where your dollars are guaranteed to be worth less every single year, playing not to lose is, by definition, a losing game. Buffett's core belief is that your biggest risk isn't market volatility. It's the devastating possibility of outliving your money. This single, powerful idea shapes his entire late-stage investment strategy. It's the reason he shuns certain assets that are traditionally labeled safe, and instead doubles down on investments that have real, durable, long-term growth potential. He's not trying to avoid the dips. He's trying to win the war against the slow erosion of purchasing power. Investment number 1. Long-term bonds. First up is an asset that might just shock you because it's the absolute cornerstone of most traditional retirement advice: long-term government or corporate bonds. For decades, financial advisors have preached the gospel of moving money from stocks to bonds as you get older in order to reduce risk. Buffett sees this conventional wisdom as fundamentally flawed. He has bluntly called fixed-income investments like long-term bonds a terrible choice for most people planning for a multi-decade future. Why so harsh? It's simple, brutal math. A long-term bond pays you a fixed coupon, a set interest payment that never, ever goes up. If your 30-year bond pays you 3% interest, but inflation averages 4% over its life, you're locking in a guaranteed loss of purchasing power every single year. You're getting poorer, slowly but surely. To Buffett, owning a long-term bond is like chaining your financial future to a block of ice on a sunny day. It looks stable and solid at first glance, but it is constantly melting away, shrinking your real wealth. He would much rather own a piece of a fantastic business, an equity coupon, as he calls it, that can raise its prices year after year, protecting its margins and growing its earnings. Not just keeping up with inflation, but handily beating it. For Buffett, the perceived safety of long-term bonds is a dangerous illusion that all but guarantees you lose the war against the rising cost of living. Investment number 2. Chasing high-yield dividend stocks. When you're retired, the hunt for a steady income stream can lead you straight into a classic trap, chasing stocks with ridiculously high dividend yields. A company offering a 7%, 8%, or even 9% yield can look like the perfect solution for paying your monthly bills. But Warren Buffett avoids this strategy like the plague, seeing an unusually high yield not as a sign of security, but as a potential signal of deep-seated problems. Now, don't get it twisted. Buffett loves a good dividend. Berkshire Hathaway receives billions in dividends each year from its holdings, but he doesn't pick a stock because of its dividend. He picks a high-quality business, and a healthy, sustainable dividend is often just a happy byproduct of that business's success. Focusing only on the yield number is a rookie mistake. It often points you toward struggling companies in mediocre industries. These companies might be paying out a high percentage of their cash because they have no better ideas for growth. Or worse, they're borrowing to fund the dividend, a practice that is utterly unsustainable. What really matters to a true investor is total return. That's the dividend you receive, plus the growth in the stock's underlying price. Some of the world's greatest companies pay very small dividends or none at all, precisely because they can reinvest their profits back into the business at an incredible rate of return, creating far more long-term wealth for shareholders. Berkshire Hathaway itself is the ultimate example. It has famously never paid a dividend for that exact reason. Chasing a high yield often means you sacrifice business quality for a short-term cash payment, and that's a trade-off Buffett is never willing to make. If this look into how Warren Buffett really thinks about retirement, investing is making you question some of the old, recycled advice you've heard. Do us a favor and hit that like and subscribe button. We're all about sharing strategies that build real, lasting wealth, not just chasing fleeting trends. Investment number 3. Over-reliance on index funds for himself. This next one is filled with nuance. It's what you might call the Buffett paradox. On one hand, Buffett has famously and repeatedly said that the vast majority of people should simply buy a low-cost S&P 500 index fund. He's so serious about it that he's instructed that 90% of the money left for his wife be invested exactly that way, with the other 10% in short-term government bonds. So why on earth is it on his personal avoidance list? Because we're talking about what he does, and for himself, and by extension, for anyone who has put in the immense work to become an expert. Buffett sees indexing as intentionally settling for average. It's a wonderful strategy that protects you from awful results, certainly, but it also guarantees you will never achieve exceptional results. As he got older, Buffett didn't diversify into mediocrity. He did the exact opposite. He concentrated his bets even more heavily inside what he calls his circle of competence. This is one of his most bedrock principles. Only invest in what you truly and deeply understand. As he wrote in a 1996 shareholder letter, the size of that circle is not very important. Knowing its boundaries, however, is vital. An index fund, by its very nature, forces you to own a piece of every company in the index. The superstars, the mediocre players, the duds, and the outright failures. Buffett would rather make huge, focused bets on a handful of wonderful businesses that he knows inside and out. For the average person, an index fund is a brilliant, simple, and effective tool. For Buffett, it would be throwing away his greatest superpower, his own specialized knowledge. Investment number 4. Speculative assets. Gold, crypto, commodities. This one won't surprise anyone who follows Buffett, but its importance is magnified in our modern, hype-driven world. Warren Buffett will not touch speculative assets that don't produce anything of their own. This bucket includes gold, all cryptocurrencies, and other raw commodities. His logic is simple, elegant, and powerful. These assets are not productive. A productive asset is something like a farm, an apartment building, or a great business. It generates rent, sells products, creates real cash flow, and pays dividends. A bar of gold, on the other hand, just sits there. In 100 years, it will still just be a bar of gold. Its value depends entirely on the hope that someone else, the greater fool, will pay you more for it in the future than you paid for it today. Buffett has famously illustrated this with a thought experiment about gold. He explained you could take all the gold ever mined and form a cube that would be worth trillions of dollars. For that same amount of money, you could buy all the farmland in the United States, plus multiple corporate giants like ExxonMobil, and still have $1 trillion left over for walking around money. Buffett's question is simple. Which would you rather own? The pile of metal or the farms and businesses that will be producing wealth for decades to come? He has been even more scathing about cryptocurrencies, famously calling Bitcoin rat poison squared. He avoids these assets because their value is based purely on sentiment and speculation. The one time Berkshire briefly owned shares in a gold miner, Barrick Gold, it only proved the point. The position was initiated in the second quarter of 2020 and sold off completely just 2 quarters later. For Buffett, betting on the price swings of non-productive assets isn't investing. It's pure gambling, and he's an investor, not a gambler. Investment number 5. Holding excess cash as a long-term investment. In scary, volatile times, cash feels safe. It's king, right? The urge to sell stocks and retreat to the perceived safety of cash is powerful, especially when you're no longer earning a regular paycheck. But Buffett has a starkly different view. He once warned, the worst investment you can have is cash, arguing it's a terrible long-term asset that is absolutely guaranteed to lose purchasing power over time. This might seem like a huge contradiction, given that Berkshire Hathaway is famous for sitting on a mountain of cash, sometimes well over $100 billion. But here's the crucial difference. Buffett uses cash as a strategic tool, not as a long-term investment. That massive cash pile isn't there because he's scared. It's his dry powder, which he keeps ready and waiting for that rare moment when one of his favorite, wonderful businesses goes on sale during a market panic. He is, in essence, a patient hunter waiting for the perfect high-conviction opportunity. For the average person, holding tons of cash for years on end is a form of financial self-sabotage. That silent thief of inflation is constantly nibbling away at your savings every single day. Buffett's strategy is to stay as fully invested in productive businesses as possible, holding significant cash only when there are no good deals to be found at rational prices. So, there you have it. The 5 things Warren Buffett diligently steers clear of as a long-term, wealth-preserving investor. Long-term bonds that are guaranteed to lose to inflation, the dangerous trap of high-yield dividend stocks, relying on average-producing index funds for his own expert strategy, speculative assets like gold and crypto that don't produce anything, and holding excess cash as a permanent safe haven. The powerful lesson that ties all of this together is that Buffett's strategy is not built on fear of short-term market movements. It's built on a deep and profound understanding of what true risk actually is. The goal isn't just to avoid a 20% market dip next year. The ultimate goal is to ensure your wealth continues to work for you, grow for you, and ultimately outlive you by decades. Real, lasting financial security in retirement doesn't come from hiding in a bunker. It comes from owning a piece of the world's most productive and durable businesses. Which of these 5 principles surprised you the most? Let me know your thoughts in the comments below. I'd love to read your perspective. For more deep dives into the strategies that build real, lasting wealth, make sure you're subscribed and have notifications turned on. And as always, please remember, this video is for informational purposes only and does not constitute financial advice. Thanks for watching.